Have you ever heard of Pets.com? If you have, you probably know what today's video is going to be about. If you haven't, stay tuned because you'll learn something, hopefully. And essentially today what we're going to be looking at is the 2001 bubble and subsequent crash in the tech industry, known as the dot-com crash. We're going to be continuing on with this series, looking at some of the more historical crashes out there, what caused them, what caused the trigger to the crash itself, and the aftermath, to hopefully learn from them and grow from them and avoid them in the future. So let's jump right into the video.
Check out financesdoneright.com for all of your personal finance needs.
So what led up to the 2001 crash? Well, it all really began in the mid to late 90s. And what happened was the internet was becoming readily available to the average Joe. Sort of looking at the 80s, the internet and the various things that you needed to access the internet when it came to computers and various other sort of pieces that you would need were very expensive. And so it was very much a novelty for wealthier individuals to have access to that. But as you reached the late 90s, the internet was really starting to take off, and a lot of people were starting to have access to it through home computers and various other means. And what happened was there was a lot of speculative hype when it came to any company related to the internet itself. Specifically, dot-com companies. Any company that had a domain name and a website was getting a very high speculative value by investors because people were thinking that the internet was going to become something truly amazing, and that any company associated with the internet was also going to become very wealthy and very successful. And so a lot of speculation started to happen. And I should note, some speculation is not bad. So speculation is essentially whenever an individual is betting that a company is going to be more valuable in the future. So they want to buy it when it is less expensive, when it is undervalued, and that it will eventually grow to that speculative value. And so, sort of perfect example, if you invested in Google 10 years ago, you would have made a ton of money because it was low value and you would have been speculating on its growth in the future. But what happened was in 2001, in the lead up to 2001, people were speculating on companies that had no business even being on the market, stock market. They had no reasonable plans for or expectations for profit. They didn't have business plans. And so what happened was there was a ton of speculative hype. A lot of investors throwing money into the market and throwing money at companies that had no business being there. And this sort of created a craze that sort of fueled itself, where these companies are rising rapidly in value. People are throwing money at them because they want to make money. And then that sort of continues. More and more people are jumping on this hype train, essentially, when it comes to investments. So that was the first problem that led up to 2001. There was a lot of unjustified speculation by investors because they thought these companies were going to become something amazing in the future. And it's an important thing to note. I was mentioning that, the internet was going to become something amazing, and people, it did eventually become something truly amazing. And it is impossible to argue that the internet has not changed radically the world when it comes to the access to information and various other things. But the key thing to note is people misjudged what would be sort of successful when it comes to the internet. People thought that any company with a domain name would become successful just because they have a website, just because they were on the internet. But the companies still need to have a business plan. They still needed to have a plan to make profits. They still needed to be a company, and that the website and sort of the internet side of the business was just an add-on to the company itself. So people misjudged what the internet would become, and that was really the key thing to note. It can be obvious that a technology is going to change the world, that it's going to have a profound impact on it. Perfect example is blockchain. It's going to have a significant impact on the future. But what is that impact? What is the form it's going to take? Is it the current cryptocurrencies? Maybe, maybe not. Maybe it's going to change into something else. So it's really important anytime there's this new technology and new industry introduced, the first form, the first introduction may not be what it eventually becomes. And it's important to keep that in mind when investing in those things. So the second major issue that led up to 2001 was the advent of day traders. Day trading is the activity where someone will buy and sell stocks multiple times in a day to try and sort of gain on short-term profits. So in the morning you might buy some Google stock, and you sell it for some Facebook stock. By lunch you're buying Amazon stock, and so on and so forth, and you're constantly making trades to try and gain on short-term sort of increases in price. And this became very popular in the lead up to 2001 because these internet companies were rising so fast. People were quitting their jobs to become full-time day traders, making all of their income from stock trading. And this again increased the speculative hype around the industry because people are buying more, they're throwing more money into the industry, and everything, once again, all these stocks are rising, massive speculative values. So that was the second major issue. Day trading became a very popular thing during that time period. The third and final really big ticket issue was the government actively encouraged all of this to happen. The government kept interest rates very low at the time period because they wanted people investing in the equity market. They wanted people investing in stocks. So they kept interest rates very low so people could borrow money to invest. If that sounds scary to you, that's because it is. Leveraging is a very dangerous sort of investing technique that can be done successfully if you're smart and safe about it. But borrowing money to invest should not be done on a whim or without a lot of thought going into it. And a lot of people that leveraged during that time period did not put thought into it. They just wanted to make money. And so you had a lot of people borrowing money to invest it too because they wanted to make more money. And then the government was not policing the IPOs. So IPOs are initial public offerings. When a company is first introduced onto a stock market, it's called an IPO. And so the government was not policing new internet companies that were entering into the market, or at least they were not policing them enough. So these new tech companies were essentially entering into the market with no business plan, no expectations for profit, nothing to justify their valuations, and almost overnight they were worth millions of dollars. It was insanity. And again, anytime you hear the word hype, anytime you hear the word craze associated with any type of industry, any type of investment, be very scared. It's not a good thing. It's never a good thing to be labeled, have those words associated with an investment. And all of those three things led up to the eventual bubble, this massive over-speculated bubble, where these companies that aren't making any money are worth hundreds of millions of dollars. And what caused the eventual crash? What was sort of the trigger event that led to it? Well, eventually these companies started releasing financial statements. And what happened was investors realized all of a sudden, oh, this company that I've invested millions of dollars into isn't making any money. And almost en masse, investors started to try and pull out as much money as possible before the crash happened, because they realized all these companies that they've been investing in are worthless, are legitimately worthless. They have no money, they're not making any money, and they have nothing to justify their valuations. And that led to a 78% loss in the market valuation. Sort of a colossal collapse, as a tremendous amount of wealth was wiped off the face of the earth. As all of sort of these valuations came crashing down back to earth, lots of money was lost, and it was a pretty devastating crash. And sort of looking at the aftermath, the really key issues that happened was sort of what really was the biggest problem was the government did nothing. You know, investor speculation, that's something that's going to happen. It's going to happen a lot. But the key is the government actively encouraged it. And that was the really sort of nail in the coffin there. That's what really led to the crash, because they weren't trying to stop it. They were actually encouraging it. They were encouraging the hype. Great thing to note, though, is that it seems like they have learned from their past mistakes. I sort of touched on a couple times during this video. You can look at a current sort of market trend, which is cryptocurrencies. Cryptocurrencies are a new technology that has a lot of hype around it. A lot of speculation has pushed these prices up to insane valuations. For once, the government did something proactive, and that is not a very common thing. So it does once again look like they've somewhat learned from previous sort of actions. The government is proactively regulating these markets. They're regulating ICOs, initial coin offerings. So remember, they didn't regulate IPOs in the 2001 crash, and that was a big sort of lead up to the crash. Well, they're now regulating ICOs. They're getting in there and making sure these coins have at least some legitimacy to them. And then they're also sort of policing these virtual wallets, making sure they have similar restrictions to banks. And they're doing things to ensure, or at least help prevent, a crash like 2001. Because there was a lot of hype, there was a lot of craze around these cryptocurrencies, and there was a lot of potential for a crash. So it is good to see the government has somewhat learned from their past mistakes. Hopefully you found this video interesting. Again, I'm going to make a couple more videos around some of the more historic crashes in the time period, the dot-com crash being one of the most historic out there, probably the most historic since the Great Depression. And yeah, hopefully you learned something from the video, and have a great day. Well, you've reached the end of the video, but don't worry, you can get access to more content at financesdoneright.com, where you'll find a bunch of tools, information, and articles that you can use to help improve your personal finances. You can also check out the 2 videos to my left if you want more content, and make sure to subscribe to the channel so you don't miss out on anything. And, as always, have a great day.